So now we're going to start actually doing the budget. So again, I hope you have your notes with you printed out so that you can go in and fill those in. I really want you to try to stop the video, try to do it on your own, and then come back and check your answers, especially as we get to where we're filling out the budgets as we go through it. Um, and then make sure you want to have a calculator there handy with you as well. So as we talk about the different types of budgets, we're going to be focusing in this chapter on these operational budgets. So these operational budgets are really looking at what we call short-term financial plan or short-term goals. By short-term, we mean over the next year, over the next 12 months. So this is what we're focusing on in this particular chapter. When we get to chapter 11, we're going to come back and look at more of the strategic budget and some of these long-term financial plan and long-term goals. So in accounting, short-term really means over the next year. Long term means more than a year from now. So when we look at our master budget, we start with the sales budget. The sales budget is what we call the cornerstone of the budgeting process. It is the single, I don't want to say the most important budget, certainly not, but it's the budget that everything else goes off of. So we start off with our sales estimate and then we go from there building all of our budgets. So once we know our sales estimate, then we know back up and we can figure out how many units we need to produce. Once we figured out how many units we need to produce, we can figure out how much materials do we need to order and how much is that going to cost us? How much labor do we need to plan for and how much is that going to cost us? How much overhead do we need to budget for? So remember that predetermined overhead rate. That's determined right here in this overhead budget. Once we've got all of our production costs figured out, then we're able to determine what cost of goods sold are going to be. We can calculate our selling and administrative expenses, and then that leads us into our cash statement and our budgeted income statement and balance sheet. Again, we're going to come back and pick up this capital expenditures budget. This will be in chapter 11. So let's get started with the budgets. Now, again, as we walk through these, you'll notice in your handouts that you have the notes there. You have the tables all built for you, and you'll want to stop the video and practice those. And I'll go through these with you, but you want to be able to stop the video and practice those as you work forward, and then check your answers. Now, I also want to encourage you, it's really important that you know where all of the numbers come from. So if I put a number up on the board and on the screen and you're not sure where it came from, you need to stop the video, pause the video, and go try to find it. If you can't find it, if you're still not sure, then post that message to the message board. Hey, I'm on slide such and such, where you're doing the sales budget. Where did you get 24,000? I can't find that number. Because if you can't figure it out here, you're never going to figure it out in your assignments later on. So I've given you the balance sheet for Smart Touch Learning. Now this is so if you think about it, we're budgeting for the 2027. This is the balance sheet for 2026. So we're going to be referring back to this balance sheet and pulling numbers off of this quite often. So you have this in your handout. Again, you might want to keep this balance sheet kind of handy as you're flipping through the pages. You might want to keep the balance sheet handy so that you can refer back to it as we get to different budgets, because we'll need to come back and pull the numbers off. A lot of our beginning balances will come from this balance sheet. So again, the budgets are prepared. We start with the sales budget, and then we're going to work our way down all the way through the selling and administrative expense budget. So we're Smart Touch Learning, and remember, we're selling these tablet computers, these iPad or Microsoft Surface sort of things, but they're Smart Touch Learning ones. We expect to sell 500 tablets in the first quarter. And we think that sales are going to increase by 50 tablets every quarter, and the expected selling price is $500. So we've already gone to our economist, to our marketing team, and we've said, hey, give us some projections for 2027. for what you think is going to happen. How many of these tablets do you think we can sell? What's the sales price you think we are going to be able to, the market will accept? And this is the data that they've given us. So now everything else is going to be based off of this sales estimate. So if it's wrong, which obviously it's going to be, it's an estimate, not actual facts, then everything else will be off a little bit. But we'll talk about that in chapter 8, how we deal with that. So here we get to our sales budget. So you've got a blank form on your page as well. I'm going to walk through maybe the first 2 quarters with you, and then I'd ask you to pause the video, try the third and fourth quarters on your own, and then come back and start the video and we'll check your answers on the next slide. So we said, hey, we expect to sell 500 units in the first quarter, and we think the sales price is going to be $500. So that means we expect sales in quarter 1 to be 25,250. Sorry, $1,000. So again, make sure you don't lose any zeros when you plug that into your calculator. Now in quarter 2, we expect sales to increase by 50 units. So we think in quarter 2, we're going to sell 550 units at $500 a piece. So we would expect total sales revenue in quarter 2 to be $275,000. So again, I'd ask you to pause the video now, try quarters 3 and 4 on your own, and then we'll check in the next slide. If you're not using a pencil, I'd encourage you to get a pencil because my guess is you're going to make some erasure marks as we go through this. So now let's compare your answers with what we actually get. So in quarter 3, we think the total sales are going to increase by another 50 units up to 600 at $500 a piece is a $300 selling price. Fourth quarter, increase another 50 units to 650 at a $500 selling price is $325. Notice the total. So we've summed across all of the total units to be sold. So we think in total we're going to sell 2,300 units in 2027 at $500 a piece. So notice we didn't sum that all the way across. And then when you multiply that out, we get the 1,150,000 as total expected sales revenue. So that works both multiplying this way and adding across this way. Now I do want to point out that in real life, using Excel to do a budget is a really helpful tool where you can plug all of the data in. And in fact, when we're in class, I show you how we do a budgeting problem together in class, and I show you how I've built it in Excel. And we plug all the formulas in, and then it's real easy to just plug in your estimates. And then as we get to chapter 8, when we talk about, well, what if there's a change in estimate and this sort of thing, you just change the numbers and bloop, it all works out. It's magic. It's fantastic. So now that we've got the sales budget, we're going to move on to the production budget. Now that we know how many units we expect to sell, we're going to look at how many units we actually need to produce. So we're going to start with how many units we need to sell, but we don't want to just make enough to sell. So for example, in the first quarter, we said we were going to sell 500 units. We don't want to just make 500 units. What if that sales estimate is too low? We also don't want to have run out by the end of quarter 1 and then start quarter 2 with nothing on hand. So we want to make some extra. That extra is this called desired ending inventory. You want to have some units extra on hand to make on hand for the next quarter. But remember, we already have some units on hand already. In fact, if you go back up to your balance sheet, if you flip over and look at your balance sheet, I've got mine pulled up on a separate screen here. I can see that finished goods inventory is $55,000. So that means I've already got some units on hand. I don't have to make those. So I'm going to subtract my beginning inventory because that's already on hand, and that tells me how many units I actually need to make. So we're told that $55,000 of finished goods inventory, which comes from the balance sheet, if you flip that over and look at it, is 200 tablets at a cost of $275 each. So if you take 55,000, divide it by $275, so that was my cost of goods sold last year was $275, then I get 200 tablets. So I already have 200 tablets on hand. Now we're told that we want desired ending inventory to be 20% of next quarter's sales. Now let me say this, every company, every problem you work is going to have a different way of calculating desired ending inventory. So don't get in your head that it's always 20% of next quarter's sales. You're going to have to read the problem, especially the homework in My Accounting Lab, read the problem very carefully and then adjust according to what they tell you. So quarter one, we know that our budgeted unit sales are 500 units. We want to have desired ending inventory equal to 20% of quarter two sales. Now, if you remember, quarter two's budgeted sales are 550 units. So 20% of 550 is 110. So this is 20%. Okay, so we're going to make our 500 tablets that we expect to sell in quarter one, plus we want to make an additional 110 tablets so that we have those on hand to start quarter two. So that means in total, we need 610 units. Now, if you remember though, we already have 200 units on hand. We don't have to make those, we already have those on hand. So I'm going to subtract those 200 units, which means I need to make 410 units in quarter one. So let's try quarter two. So we already know that quarter two's estimated budgeted sales are 550 units. We want ending inventory equal to 20% of the next quarter sales. So that's 20% of quarter three sales. So quarter three sales are estimated to be 600 units. So 20% of 600 is 120. So in quarter two, I need a total of 670 units. Now, I don't have to make all 670 because remember, I'm expecting to have 110 on hand from quarter one. So quarter one's ending inventory becomes quarter two's beginning inventory. So I don't have to make these 110 because I made them in quarter one. So in total, I need to make in quarter two 560 units. So now I want you to pause the video. You try quarter three and four on your own, and then we'll come back together and check it. So, did you get it right? So let's start with quarter three. So we already knew that quarter three was 600 units expected sales. We wanted desired ending inventory equal to 20% of quarter four sales, which are 650. So 20% of 650 is 130. So in total, we needed 130 units. Plus the 600 we expected to sell, so in total we needed 730, but we didn't have to make 120 of those were already made, so in quarter three we needed to make 610 units. Now for quarter four, we expect to sell 650 units. Our desired ending inventory would be based off of quarter one of 2028's sales. So if we continue with the assumption that sales are increasing by 50 units a quarter, then quarter one of 2028, we would expect to sell 700 units. So 20% of 700 is how we get the 140. So that gives us a total of 790 units, but we had 130 on hand from quarter three, so we don't have to make those. So then we only need to make 660 units. Now, notice the total columns. We summed all the way across the total number of units sold, and that's 2,300, just like it was when on the sales budget. But notice the desired ending inventory. We don't add that all the way across. This is saying at the end of the year, how many units do we expect to have in ending inventory? So that's just the 140 from quarter 4. Now, notice that this works adding down. It's not going to work adding across. That's okay. Then we have our beginning inventory. Again, that's not the sum of all the beginning inventories. That's just the beginning inventory at the beginning of the year. So think of the total column as the year in total. So at the beginning of the year, we started out with 200 units. So we want to subtract those. I like to put parentheses around these that we're going to subtract to help me remember that I need to subtract those. So in total, I need to produce 2,240 units, and that works going down and adding across that way. So now that we know how many units we need to produce, we're going to need to go through and do the budgets for each of our 3 product costs. So we have a budget for direct materials, for direct labor, and also for overhead. So let's start with the direct materials budget first. So the first thing that we need to do is calculate, we're going to start with how many units we need to produce. So that's going to come straight off the production budget. Okay. Then we're going to figure out how many materials it takes to make a tablet. So we already know this. We will know this. So we'll multiply that out. So we'll know that how much materials we need in total. Now, just like with production, we don't want to order just exactly enough materials. We want to have some extra on hand. What if there are shipping delays? What if we end up making more units than we produced? We don't want to have to slow down because we don't have materials in time. We want to have the materials on hand when we start quarter 2's production. So we want to order some extra materials. We want some desired ending inventory. But we already have some materials on hand. So if right now you'll flip back to your balance sheet, you'll see the direct materials line, the direct materials inventory in the balance sheet. That's how much we already have on hand. So we don't have to buy that. So then this tells us how much materials, whether that's pounds or gallons or yards or whatever, that we need to buy. And then we'll multiply it by our budgeted cost per pound. And that will tell us how much money we expect to spend on materials. So let's look at our data. We're told that every unit that we produce requires 3 pounds of materials. So that's a lot. These are very heavy tablet computers. Okay. Every unit requires 3 pounds of materials, and we expect each pound of material to cost $50. If you look on the balance sheet, the direct materials inventory is $30,000 or 600 pounds. So 30,000 divided by $50 a pound is how we get the 600 pounds. We want ending inventory to be 40% of the next quarter's production needs. So we want to go ahead and have those materials bought and on hand so we're not waiting on shipping. And then they just go ahead and tell us that for the 4th quarter, our desired ending inventory balance is 852 pounds. We could have figured that out, but they just were nice to us and gave it to us. So let's walk through our budget here. So going back to our production budget, so you may want to be working at this kind of spread out at a desk where you can have all of your budgets laid out in front of you and you can kind of keep referring back to them, because this line right here is coming from the production budget. So we know, based on the production budget, that we expect to produce 410 units in quarter 1. And each unit uses 3 pounds of materials. So that means in total, we need 1,230 pounds. Now, I like to go ahead and identify whether it's pounds or dollars or units, because we're going to have all three in this budget, and it helps me keep it straight so I don't get confused. Now, I want my desired ending inventory to be 40% of quarter two's production needs, but I need to first calculate quarter two's production needs. So for quarter two, if you remember, and flip back to your production budget if you don't, we expected to produce 560 units. And each unit is going to use 3 pounds of materials. So that is a total of 1,680 pounds. So my desired ending inventory for quarter one is 40% of that 1,680. So 40% of 1,680, if I've done my math right, is 672 pounds. So that means in quarter one, I need the 1,230 pounds just to make quarter one's production. Plus, I also want to go ahead and pre-buy 672 pounds that I'm going to use in quarter two. So in total, I'm going to need materials of 1,902 pounds. But remember, I already had 600 pounds of materials in beginning inventory, so I don't have to buy those. I already have those. So the total that I need to buy is 1,302 pounds. Now remember, the materials cost $50 per pound, so 1,302 pounds multiplied by $50 is a total of $65,100. So I expect to buy 1,302 pounds and spend $65,100 on those materials in quarter one. So let's look at quarter two. So we've already done the quarter two's production, direct materials needed for production. Now I need to calculate my desired ending inventory, but in order to do that, I have to calculate quarter three's materials needed for production. So quarter three's tablets to be produced based off the production budget is 610. Multiplied by 3 pounds each, and that is 1,830 pounds of materials. So I want to pre-buy in quarter two 40% of that. So 40% of 1830 is, I believe, 732. So that means in total, I need 2,412 pounds of materials in quarter two. Now, the good news is I don't have to buy all of those because remember, I pre-bought some of quarter two's materials in quarter one. So this 672 pounds of materials that I bought in quarter one become quarter two's beginning inventory. So I'm going to subtract those because I don't have to buy them. So that means the total number of pounds of materials that I need to buy in quarter two is 1,740 at $50 a pound, and I believe I need to spend $87,000 on materials in quarter two. So you go ahead and finish quarter 3 and 4, pause the video, and then come back and check your answer. So how do we do? So we continue with quarter 3. We had already calculated quarter 3's production needs. In order to calculate our desired ending inventory for quarter 3, we had to calculate quarter 4's production needs. We took 40% of this 1980 to get our desired ending inventory for quarter 3, pardon me. Let's see, I wrote on that, so this is the 40%. So then I can subtract out my beginning inventory, which came from quarter 2. So again, I like to put these in parentheses because I'm subtracting them. So that tells me for quarter 3, I need to buy 1,890 pounds of materials at $50 a pound is $94,500. For the fourth quarter, they gave us the desired ending inventory. Again, we could have calculated it because we know quarter one of next year's sales, so then we could have gone back and calculated their production and so on and so forth, but they were being nice to us. We know that quarter four's beginning inventory is quarter three's ending. And so in quarter four, we need to spend $102,000 to buy 2,040 pounds of materials. Now, again, if we look at our total columns, notice the ending inventory is just quarter four, and the beginning inventory is the beginning of the year. So that total is really the year-end total column. And so now we know that we need to buy a total of 6,972 pounds of materials, and we're going to spend $348,600 on those materials. So now that we've got the materials budget done, we need to do the labor budget. So we're told for the labor budget's much easier because we don't have any inventory to deal with. So for the labor budget, we are told that each tablet will require 3 hours of direct labor, and the direct labor average cost is $25 per hour. So if we go and look at this, we're going to go back to our production budget to pull this data. So we know that in quarter one, based on our production budget, that we are going to make 410 units. And we're going to spend that's not a dollar sign. We're going to spend 3 hours on each unit. So that means we need a total of 1,230 direct labor hours. If we pay an average of $25 an hour, that means we can expect to spend $30,750 on labor in quarter one. So now let's do quarter two together. Going back to our production budget, we know that we expect to produce 560 units. At 3 hours per unit, that means we are expecting to spend a total of 1,680 hours, and at $25 an hour we're expecting to spend $42,000. So again, you pause the video, complete quarters 3, 4 in the total, and then we'll come back and check it. So when we look at quarter three, we see that we're going to need 1,830 hours and $45,750 for labor. And then it goes up some more in quarter four to 1,980 and $49,500 in total. So in total, we're going to need 6,720 hours of labor planned and $168,000 of labor money spent on labor. Now, before we go any further, I want to point out that this budget, again, is not just for spending money, but HR, your schedulers, your programmers, they're going to be looking at this and figuring out how do we need to structure people, right? So if I know that in quarter one, I need people to work 1,230 hours, I need to make sure that I have enough people to work that number of hours, to their shifts. If I don't have enough people, if they're going to have to work overtime, then I need to, somebody in HR or in planning, whoever does your hiring and your scheduling is going to be going, wait a second. We don't have enough people to work that many hours without going into overtime. If we're going to have to do overtime, then that's going to change that $25 an hour cost. So these are discussions that we're going to be having. If I'm looking at this and saying, all right, in the first quarter, I'm going to need people to work basically 1,200 hours. And by the end of the year, I'm going to need people to work basically almost 2,000 hours. I'm probably going to have to hire some employees as we go along. So I need to know now, because HR's got to start putting out hiring. They're going to, I don't know how long it takes to hire and train where you work, but here at TCC, it takes a good 6 months to hire an instructor and get them into the classroom. So if I know that I'm going to need some more people to start work in maybe July when the third quarter starts, maybe October when the fourth quarter starts. I'm going to need to start planning to hire those people back in January and February so that I can make sure they're onboarded, they're trained, and they're ready to go. So these are all discussions that we're going to need to be having as we're going through this budgeting process. Now, the last of the three production budgets, the three product cost budget, is overhead. So we're going to do our manufacturing overhead budget. Now we're told that we have some fixed cost and some variable cost. Our fixed costs are $12,000 per quarter for the depreciation on the manufacturing equipment. And then we have $15,440 per quarter of other fixed cost. That's probably insurance, that's probably property taxes, maybe that's a supervisor, the factory supervisor's salary, all sorts of those other things. We've just kind of combined them all together into one budget, one fixed cost number there. When we calculate our predetermined overhead rate, we are told that the direct labor hours are the allocation base. And then we have the formula for the predetermined overhead rate there also. Now, the other thing is we're told that our variable overhead costs are expected to be $20 per tablet. So what we've done is we've taken our overhead costs for the past year and we've done our high-low calculation. So we've split it into our variable cost and our fixed cost. And so with our variable cost, we know that that's $20 per tablet. We know that our fixed costs are $27,440. 12,000 of that's depreciation, 15,440 is other things. And we'll talk about that. That becomes important in a little bit, so we'll come back and talk about that a little bit later. So going back over here to our overhead budget. Now, first of all, we're starting off with number of tablets we need to produce, which comes straight off that production budget. So in quarter one, we expect to produce 410 tablets. I didn't write that very well. Let me erase and start over. We expect to produce 410 tablets. Remember that variable overhead cost is $20 per tablet. So we can go ahead and multiply that out and say, okay, well then we're expecting variable overhead to be $8,200 in quarter one. Now, our budgeted fixed overhead, and this is kind of like a header here, is depreciation of $12,000 per quarter. So that's going to be $12,000 per quarter all the way across. We can go ahead and write that one all the way across. And then our other things like insurance, property taxes, stuff like that is $15,440. Again, we can go ahead and write that all the way across since it's not changing. So total fixed overhead is $27,440. And since it's fixed, we're not expecting it to change as production changes. That variable overhead is going to change. So now the total budgeted overhead is the $8,200 of the variable cost plus the $27,440. So for quarter one, that is $35,640. Now for quarter two, it's going to be a different amount, and don't use these charts here till the very end. I'll show you how to do that at the end. So for quarter two, let's go back to our production budget. We know that in quarter two, we are expecting to produce 560 units. Variable overhead is $20 an hour, or excuse me, $20 a unit. And so then we expect variable overhead to be $11,200. Plus the fixed overhead of $27,440 gives us total overhead for quarter two of $38,640. Now, you pause the video and try to do quarters 3 and 4, and then we'll come back together and finish. All right, are you ready to come back? So I'm going to go ahead because this one's kind of short and finish this out here with you. So quarter three, we expected to produce 610 units at $20 a unit is 12,200. We add that with our fixed overhead and we get 39,640. I have a neat one on the next slide for us to look at. And quarter four is the 660 that we expect to produce in quarter four, multiplied by $20 a unit, which is 13,200. Add that with our 27,440, and we get 40,640. So when I look at my total column, I still expect to produce in total 2,300 units. At $20 a unit gives me 44,800 variable cost. My total fixed cost is 48,000 for depreciation, 61,760 for property taxes, insurance, yada yada. So total fixed cost of 109,760. Add that with my variable and I get total budgeted overhead for the entire year of 154,560. So this is now my numerator in my predetermined overhead rate. Now remember, we are allocating overhead on the basis of direct labor hours. So flipping back to our direct labor budget, if you look in that total column, we expected total direct labor hours to be 6,720. So this is my denominator for my predetermined overhead rate. So now I can say 154,560 divided by 6,720 gives me a predetermined overhead rate of $23 per direct labor hour. So here I have a nice, neat version for you to look at where you can get all of your numbers written down in case you had a hard time reading my kind of chicken scratch on there. I admit that my handwriting isn't the best anyway, but it's really not good on this tablet. And again, don't forget that we calculate this predetermined overhead rate now. So this means for all of 2027, when we're doing job order and our process costing, we're applying overhead at a rate of $23 per direct labor hour. Okay, so now we've done the sales budget, the production budget, we've done all three of the product cost budgets. Now it's time to do what's called the cost of goods sold budget. The cost of goods sold budget is going to calculate the total cost of one unit. How much does it cost us to make one unit? So we know that the three product costs are materials, labor, and overhead. So we're going to total up the cost of making one unit of materials, making how much materials is it to make one unit, how much labor is it to make one unit, and how much overhead is it to make one unit. So let's go back to our materials budget. If you flip back there with me for a minute, remember each unit uses 3 pounds of materials, and we're told that the materials have an estimated cost of $50 per pound. So that means the materials cost is going to be $150. We expect every single unit to have $150 of materials. Now let's go to the labor budget. We're told that each unit uses 3 hours of labor, and labor costs us $25 an hour. So we expect each unit to get $75 of labor. So now we need to go to the overhead. So we know that overhead is applied at a rate of $23 per labor hour, and based on the labor budget, we know that each unit is expected to use 3 hours of labor. So 3 hours of labor at $23 per hour is $69 of overhead cost. So we expect all of our units that we produce in 2025 to have a total cost of $294. So every time we sell a unit, we're going to debit cost of goods sold, credit finished goods inventory for $294. Okay. If we're using process costing, then every time that we move units out of work in process into finished goods, we're going to debit finished goods for $294 a unit because that's how much we're expecting it to cost. Okay. Now, if you remember back when we did the production budget, we were told finished goods inventory, remember, is $55,000, and that represents 200 units at a cost of $275. So that means last year the tablets were cheaper to produce. They cost $275 last year. This year they're going to cost $294. They went up. They got more expensive. That's not all that surprising, but it is something that we need to know. In fact, they went up by $19 a unit. That's really significant. Okay, so again, that's something that we need to know that we're going to need to take into consideration. So now we can create what's called the cost of goods sold budget. So for each quarter, how many units we expect to sell multiplied by the price. Okay. So I like to write, and this is just me, I'm going to write up here my sales estimates. If maybe you have your sales budget in front of you and you don't have to. But remember, these were our budgeted sales for each quarter. So in the first quarter, we were going to sell 500, and then 550, and then 600, and then 650, right? So I just like to write that up there as to remind me. So in the first quarter, we expected to sell 500 tablets, but the first 200 of the 500 that we sell are going to be the old ones that we made last year, those that had a cost of $275 each. So the beginning inventory, the first 200 units, okay, are going to have a total cost of $55,000. That comes straight off the balance sheet. That's those 200 units at $275. Okay. Now, the next 300 units, so I'm going to write this up here really small, 200 times 275. Now, the next 300 units that I sell are all going to have a cost of $294. So these units at $294, 300 units at $294, gives me $88,200 for total cost of goods sold of $143,200. Now, after this first quarter, I've sold all of the old units that were cheaper. So the rest of it is just the sales times 294. So for the second quarter, I expected to sell 500 units times 294 is how I get 161,700, which is my total. Because all of those units are produced in 2027, so they're all at the 294 level. So pause the video, try quarter 3 and 4 on your own, and then let's check it. So quarter 3 is going to be the same thing. It's just the 600 units at 294, and quarter 4 is the 650 units at 294. So in total, I think at the end of the year, cost of goods sold is going to be $672,400. All right, one more budget. I know that this has been an exceptionally long video, but one more budget before we take a break. And that is the selling and administrative expense budget. So these are all of the period cost, remember? So here we're told we have a lot of them are fixed: salaries, rent, insurance, depreciation. Only one cost is variable, and that is supplies, and it's 1% of revenue. So we'll need to refer back to our sales budget for that one. So let's look at this. So our salaries expense was fixed across the board. We were told it was $30,000 every quarter, so I can go ahead and fill that in all the way across. My rent expense is fixed across the board at $25,000, so again, I'll let you fill that in all the way across. My insurance is fixed at $2,500. I'll let you fill that in all the way across. Depreciation is fixed at $1,500. Let you fill that in all the way across. And supplies is fixed at 20. Sorry, supplies is not fixed. Supplies is our variable one. Woo! So supplies is 1% of sales revenue. So we're going to need to refer back to the sales budget. So in quarter one, my sales revenue was $250,000, and 1% of $250,000 is where we get $2,500. So that's 0.01 times $250,000. So when I add all this up, my selling and administrative expense budget for quarter one is $61,500. So quarter two, it's the same thing, the 25,000, the 30,000, the 25,000, the 2,500, the 1,500, and then my supplies is again going to be 1% of sales revenue, which was 275,000. So that makes this 2,750. So when I add that up, I get 61,750, and I'll let you complete quarters 3 and 4 and then unpause the video and come back and check. So, how'd we do? I'm sure we did great. So the only thing that changed again was our supplies expense. Each quarter went up a little bit. So in total, we expect to spend $247,500 on selling and administrative expenses in 2027.